this is the history of the rupee. In 1947, it was 3.32 rupees to the dollar. So that whole WhatsApp forward about one rupee to the dollar is not true, but it's not that false either. I mean, 3.3 to 86, 87 is quite a journey. And anyone who's held savings in dollars versus rupees has clearly benefited over the long term. This was the Times of India headline. The rupee goes from 4.7 to 7.5 to the dollar. Now remember, this was a controlled currency. It was not a managed float like it is today. It was set by the government, so it was very abrupt. One day you woke up and suddenly the rupee was worth half as much. You might see a disconnect between the headline and my 56%, but that's because Times of India calculated wrongly. So if you, it's actually 56%. This is my favorite chart about international investing because it gives you, in a single image, the history of the world stock market. This is a study that's released every year by 3 professors, Dimson, Marsh, and Staunton. What it tells you is the rise and fall of countries and their stock markets, and why being only in one country is risky. So if you begin with 1900, we have USA at 15%, not the biggest market in the world. The biggest was 24%, which is Great Britain, right? British Empire. And if you see Great Britain, it's just a century of slow decline, all the way to 3% at present. The United States is interesting. It begins at 15, it goes up, up, up. And then in the 1980s, it has a decline. Not because 1980s was catastrophic for the US, but because another country had a massive boom, right? And that country is Japan. Over here, Japan. And then Japan has its crash. All of you guys know the anecdote about the land underneath the Imperial Palace being worth more than the state of California. That was so they also had real estate boom along with the stock market boom. And Japan then crashes, has a lost decade. And I think that's 6% of the world pie that goes to Japan. Now, naturally, you will ask, where is India in all of this? India is too small to be represented in this chart. It was small earlier and it is too small now. My hope is that it increases and takes its place in the sun. But while it does, it's important for us as investors to also keep our eggs in the other baskets, because we don't know kaun sa ghoda jeetne wala hai. That's the honest truth. We think, and I'm hopeful, and I'm sure all of us are hopeful ki hamara ghoda jeetne wala hai, but baki ghode bhi hai. Now, there are a couple of ways to diversify. So the simplest way is mutual fund. Now, the issue with mutual fund is that since 2022, RBI has not lifted the industry cap on mutual fund of 7 billion. And so you have most funds who are shut, some of them open for a brief while because if there are redemptions, then they are allowed to take in some more money. But it's like a local train, ki agar koi niche aaye tabhi you can get in. Nahi to the train is full. There's no space to get in. Now, within mutual funds, there are some funds which are a mix of India and global. And we have one such fund represented here, Parag Parekh. And they are still open. They have never closed because they also have Indian stocks. But what has happened there with them and similar funds is dilution. So they used to have 35% international exposure at one point of time. And now they are down to 10, right? Raunak, roughly 10%. So it is a solution. It's not the perfect one. It's a simple one, both from a tax and from a convenience point of view. But it has its cons because it doesn't give you as much global access as you would want. Then you have, you can open a broking account through LRS, through Liberalized Remittance Scheme. And usually our audiences know this already, a lot of the details. So I won't go into too much of it, and Subho will explain some of the procedural angles. So save your questions for his session. But just roughly to give you the basics of it, $2.5 lakh every year you can invest. Above 10 lakhs, there is tax collected at source or TCS. There are numerous restrictions on what kind of instruments you can invest in once you remit the money, etc. But broadly speaking, you can invest in stocks and ETFs around the world through LRS. And you have to be very careful about tax compliance. I like rigor. I like numbers when it comes to finance. even though I'm a journalist and I tell stories for a living. And this to me is the number, is the scientific number to make the case for global investing, which is that in most countries, so what does this tell you? If you're an investor in most countries, let's say you're an Italian investor over there, or let's say Irish investor or Brazilian, if you had diversified abroad, your Sharpe ratio would have gone up. So next up, we have Swanand Kelkar, who is currently managing partner at Breakout Capital, and earlier was managing director at Morgan Stanley. He works with Ruchi Sharma, and you would have, I'm sure, read the books. I've been a fan for a long time. Swanand is famous not only for his work, but also for other things he does. He took a sabbatical before the pandemic, and he had a podcast about that. And hopefully he'll tell us some tidbits from that also. But without further ado, Swanand, please come up and address the audience.
So I'm very, very happy to be in Pune and to be introduced by somebody who can correctly pronounce Kelkar. So thrilled by that. Even I have settled to calling myself Kelkar, but feels just good to have your surname pronounced correctly. I'll say a couple of sentences about Breakout Capital. I'll tell you what we do. Breakout Capital is an emerging markets public equity, listed public equity firm. So we invest across multiple emerging markets. I'll start off by making the same point. There is a crass way of saying what Neil said in a very polite way, that your head is generally where your ass is. And that means that you think that the only place worth investing is where you are sitting. And that has been India, nothing against it. But I have just plotted the 24 large emerging markets that we look at. India is highlighted in yellow. And thus these are the returns on a year-to-date 1, 3, 5 and 10 year. These are dollar total returns. So in the last 1 year, right, we have been saying, oh, Nifty is going sideways, this, that and the other. Of the 24 markets that we track, 19 have done better than India. Over a 3-5 year time frame, over a 10-year time frame, India has definitely done well. So there is life beyond the home market is the limited point that I wanted to make here. This is what US has been doing. US has been pulling in a lot of money. It is about 27% of global GDP, which is the third bar there, but accounts for almost 2/3 of the equity market capitalization of the world. Right? That is the sort of dispersion between the two metrics that you typically end up looking. We track this number closely. It has peaked in December at about 68 and a bit, and has since corrected about 2-3 percentage points. So the one thing to keep in mind is, especially the last decade, the fantastic return that Neil's dad's made has been an exceptional decade for US investing. And it has been so exceptional that things look very, very lopsided when we look at it from different economic metrics. So there is always a corollary, the other side of the coin, and this is emerging markets. So the two tan columns on the left are basically what global institutional investors, what percentage of their portfolios are in emerging markets. So they're somewhere between 7 and 9%. On an all country weighting, what is the weight of emerging markets? It's about 11%. But all put together, all emerging markets account for about 43% of the global GDP. Again, a quick recap. Diversified, ignored, cheap, and generally has the building blocks of success in place. Right? That's the fourth sentence that we have added now over the past few slides. But is it a value trap? 5 P, 0 growth? It is not. These are again Bloomberg consensus numbers. To look at the ROE of emerging markets is about 13% expected this year and next. And as a whole, you will likely get an earnings growth of between 12 and 13%. Within this, you have to stock pick. Within this, you have to ensure that you are in the right countries. But as a whole, there is enough momentum out there. There is enough current in the river for you to be flowing downstream. It's not as if this is 0 earnings growth and 5% ROE sort of an asset class. So this is not a value trap. There is enough growth out there. You can argue whether the growth is cyclical in nature, is it more secular in nature, etc. But there is growth to be had. And if you care about ROE and growth, which are generally metrics that fundamental investors look at, there is enough to get excited there. I think I briefly mentioned is that the US dollar weakening is generally good for emerging markets. A, because of the currency returns. If the US dollar weakens, emerging markets return for US dollar based investors improve. if you're already invested in the country. So typically when we used to pitch to investors maybe 5 years ago, we used to say from India, you can expect 15% local currency returns, but the currency will depreciate 2-3%, which means that your US dollar returns will be somewhere like 11-12%. Now we can probably say that you expect local currency returns of 15%, and there is a likelihood that the INR USD will add to your US dollar returns if the dollar depreciates against the rupee. So I think that generally increases the attractiveness of emerging markets for US dollars based investors like us or other FIIs. Neil asked me to add this slide specifically because people want to know what about China. China is an important part of emerging markets. At different points in time, it accounts for between 20 and 25% of MSCI emerging markets weight. So the 3% weight that Neil showed on his chart, which shows the UBS market capitalization split, where US was at 65%. China is at 3, emerging markets put together as about 11 or 12%, which means about 25% in EM is China. China has the 3D problem. I'm sure this you know about this through different means. One is the debt. They are highly indebted, unlike what I said about most other public debt metrics for other emerging markets. China is the only exception to that chart, where their debt overall, including public debt, is reasonably high. They're currently going through deflation. When they produce a 5% real GDP growth, they typically produce a 4% nominal GDP growth. That's the deflation problem, where prices are actually going down year on year, and too much of a good thing can be bad. And that's what they say about deflation as well. In India, for instance, there is a 6.5%, let's say, real GDP growth, and you get 3-4% inflation, hopefully, which means that you get a 10-12% sort of a nominal GDP growth. That environment is amazing for a stock picker, right? Because the economy is growing 10-12%. You have to find sectors which are growing maybe 12-15% within that, stocks which are growing 15-18%, and you're home. But in a place like China, where that is a headwind, where inflation is kind of detracting from real GDP growth, it's not good for corporate earnings. Demographics problem is well documented. It's now reasonably certain that China will grow old before it grows rich. So not enough people joining the workforce, etc. These are all long-term sort of problems that most economists, I mean, if you read people like Stephen Roach, they'll keep banging on about this. But that's just something to keep in mind, that there is the secular case for China is not very strong. I'll wrap this up. EM is Sasta. I think I made that point. Is generally Sundar, in the sense most of the macro excesses are not there. The place seems to be primed for growth. Few things need to fall in place, but it's generally Sundar, and it's hopefully Tikau. Again, because the starting point valuations are not very heavy. Yeah, yes, hi.
I just wanted to know what do you feel about the AI stocks? And when I say AI stocks, I'm not talking of the AI stocks
in
India,
okay,
or in the US as well. But AI stocks are doing good even in China. I can't talk about Russia because it's a closed market like thing today.
Correct.
But China is more open. So China versus India versus US for AI. What's your opinion on that? Or any other market which I must have not skipped, you can just tell out there.
So AI is a very dominant theme within emerging markets today. So stocks like, not even in China, even in places like Taiwan, TSMC, which is the largest fab manufacturer, or SK Hynix in Korea. These are some of the stocks that are very levered to the AI boom. So if you think about AI in general, right, there are these so-called hyperscalers in the US who are spending a lot of money setting up data centers and setting up massive investments. And people who provide multiple equipments to these data centers are the ones that are benefiting, which includes likes of NVIDIA, which makes the chips, which includes multiple electricity power consumption companies, which includes transformers, etc., etc. So the current AI investment is what is known as, in investing, the picks and shovels model. Will enterprises adopt AI? What will be the effect of AI on productivity? How will it change the world? I don't think any of us are answering those questions today as investors. What we are saying is, okay, what are the big guys spending on? They are spending on building data centers. What do data centers need? They need chips. Who makes these chips? NVIDIA makes these chips. Who supplies to NVIDIA? TSMC does it. Right? So that is how the AI investing landscape has evolved. I do not have a very firm view on the worldwide adoption of what happens at an enterprise level from an AI standpoint. But the current ascendant narrative of AI is to invest into the spends of these companies who are building all these things which are related to AI, and a lot of them are in the emerging markets. So if you end up investing in AI, we have investments within TSMC, SK Hynix, all these names. You have to keep watching the capital expenditure spending of some of these US hyperscalers, the Googles, the Metas of the world, closely, because that is where the money for the AI plays across emerging markets is being made. Thank you, Neil. Thank you for the great questions. Very.
Swanand, thank you so much. All right, now I'm just going to call our next speaker. So if you thought of the landscape 10 years ago, if you had asked the question, how do I invest outside India, you'd have got almost no answer, because there was maybe one broker that was operational. There was no fintech, there was nothing. Now that's been transformed, and Appreciate is part of this new set of fintechs that are enabling global investing to Indian investors, including retail investors. And that's not all they do. They do many other things, and he will talk about that. But without further ado, Subho Moulik, who's founder of Appreciate.
So I'm going to talk a little bit about context. I think they've given you enough numbers to set the basic background that diversification is great. The US market has lots of opportunity. There's emerging opportunity in emerging markets, no pun intended. Let me talk to you about three things extempore. One is, let me give you some US context, because I think there's a debate about what's going to happen in the US. We have a view. So I'll talk about two or three of those key indicators and what to look out for, and why I think US competitiveness is more likely than not going to persist. And the reason I say more likely than not is because you do have a certain individual there, and while I think he's a blip, he may not be, right? So we'll talk about that. Then let's come to you. How do you invest abroad? How should you think about LRS investments? What are we doing to make it easier? Indeed, we're actually talking to a few fund houses to make their portfolios more accessible to you. How does that pan out? So I'll talk about that, which I think you should be interested in because it's actionable for you. And then I'd like to talk a little bit about, at the end, about AI, ML broadly, but also in the context of how you should invest and how it is fundamentally changing the game in financial services for institutions, but more importantly for you as an investor. And it will turn certain long-held, I think, wisdoms or home truths on their head. So let's talk about the US. I think what you're seeing in the US right now is something that started 10 years ago. Most people don't recognize it. There was, an election of an African-American liberal president, right, which was Obama, right? And 8 years of that created enough of a building backlash, along with more inequality, income inequality between educated and uneducated, sections of society in the US, that has led to Trump and basically, a anti-liberal, anti-global coalition arising, right? What's that also doing is that a lot of what's happening in the US is culture war perspective, right? So there are culture wars, etc., that's coming in. It's largely focused on a domestic agenda. Today, the US is insular, it doesn't look outside. What's happening also because the culture wars is that you're seeing US attacking its own institutions that have led to technological edge, to attracting the best folks, right? To ongoing immigration of extremely high quality individuals. What I believe is that the midterms that are coming up, right? If the Republican Party sweeps the midterms and there is no check, you're going to see an acceleration of this because the report card will be, hey, there's no consequences to these actions. And you'll see this continue, at which point it's not irreversible, but there will be more reaction from the rest of the world. Whereas if you see a significant midterm rejection, right, either because tariffs start hitting and inflation goes up and people don't like it, or because you have, more and more armed forces deployed in multiple cities and people say this is too much, I don't want this, right? For whatever reason, you'll actually see a check on Trump and the administration. And then, this will truly be a blip. So I think US short-term political outcomes will influence medium-term actions, right? Second, I think from a competitiveness perspective, there are plenty of industries, whether it's, biotech, AI, ML, core quantum computing space, where it'll take a while for either an emerging market or another developed economy to actually catch up to the US, right? It's got a significant head start. And if you look at what's going to drive outsized performance, the outsized performance in the US has not happened. And I think Swanand had this, right? You have concentration of market capitalization. That's because there are some companies that have become globally very successful and dominant, right? And the US's ability to continue to produce that is what drives it. If you look at what drove the Great Britain decline in share, right? It was the East India Company collapsing. East India Company was, Amazon, Microsoft, Google, all combined in its day. The fact that that collapsed as a global sort of, Hoover that would vacuum profits into Great Britain led to the collapse, right? And as long as the US can continue to generate companies in various fields, right? And what's going to happen? I don't know how many of you know CRISPR, but CRISPR and increased genetic medicine is going to be a revolution in medicine over the next 5 to 6 years, not 15 years, 5 to 6 years. Most of the research is being done in either the US or UK, right? While there are other space companies, commercial space is fundamentally based out of the US today, though I think India has a very interesting play here, right? If you look at quantum computing, right, let's debate whether Google's further ahead or Microsoft's further ahead, but no one's quite there, right? If you look at AI ML ecosystem, right, bulk of the progress is being made in the US and some in China. So the US as a leader of technology-based, economic domination will continue for a while unless the government actually takes a hatchet to it. And, unless Trump for some reason is there for another 8 years, which I don't think he'll be, this is going to be a blip that we will forget, right? Because, he's going to be 85, not able to tweet anymore and, off like most of us, right? No one escapes this life, right? We all die. So that's a little bit about US macro environment. Now let's come to, what does that mean for you in the short term and in the medium term, which is what you're quite interested in as well, right? Not just the long term. Everyone's dead in the long term. You have to, I believe, continue to provide a significant portion of your diversification capital towards the market that's likely to yield you the best returns, right? And so how do you do that? So a couple of things. What we have done at Appreciate is enabled you to access LRS investing at your fingertips, right? So it's a 3-minute onboarding journey, which is basically Aadhaar, PAN, VKYC, right? You then get access to an international 3-in-1 account, right? An Appreciate account, a US broker account, soon to be a multi-broker account, and a bank account where you can integrate, send money. And while we're focused today on the US, in line with, I think, what Swanand and Neil are saying, we will enable additional markets as well because we think there are interesting stocks in many markets, not just the US, right? Then what you do is, because, for context, as you know, sending money out of India, we are also not a freely convertible currency. Sending money out of India is difficult for a reason. We have taken that and simplified it, right? So in the background, we do 6 to 7 checks integrated with a bank that's fully compliant, that enables your money to reach your account seamlessly in super quick time with no hassle, all digitally. It's almost unheard of, right? The banks we work with, when we started working with them, they had first time right LRS remittances of about 30%. They are now at about 99.999%, right? Time to process used to be 48 hours. It's now a couple of seconds. So significant ease of the remittance journey, right? The other piece that we also do, which is interesting, is we give you multiple options to invest. And you'll see this come from us over the next 6 months, right? Of course, you can pick your own stocks, right? Initially in the US, in other markets. You can also invest in portfolios, right? So we talked about sort of Sharpe ratio optimization. We run algorithms that can help you optimize Sharpe ratios across multiple portfolios. You can create your own portfolios or invest in portfolios. We'll soon have other funds that are available, right? International funds available where you can invest outside. And we are talking to a number of fund houses to say, hey, can you partner? Because, if an Appreciate and a fund house partnership enables the cap not to apply to you, but you're more comfortable saying that, hey, there's an sort of an end avenue where there's an experienced fund manager directing your investment and you're choosing them, right? So we'll provide you a number of different ways. And as an investor, you decide whether you want to pick a direct stock, whether you want to invest in a portfolio, whether you want to put your money into an Appreciate, let's say a PPFAS combined entity where, it's directed by their expertise. choice is yours, right? But the point is, it makes sense for you to diversify. Your jobs are here, your homes are here, right? Your disposable cash is here. At some point, if I were to tell you, put all your money into one stock, you'd say you're crazy. Why would you put all your money into one country, right? We're global citizens. You have the ability to diversify. So I would recommend that you use the tools you have, such as the app that we have, and you put 25 to 30%, right? I wouldn't suggest put 60% of your money outside, right? Though I have 80% of my money outside, so I put my money where my mouth is, right? 20% of my portfolio is here, 80% is outside, and I've done pretty well. At least 35, 25, 30, 35%, you should diversify. There's no downside, right? Typically. So that's what I'd like to say about how you do it. Now, the last piece is how you invest. So I think the traditional wisdom has been I agree with Swanand's comment, right? That you invest for your assets. There's significant home bias traditionally, and it's been there for almost 3 decades. What we've been seeing recently is that home bias is being replaced, right? Not by location, but by behavior. So your home bias, you have more home bias connected to your phone, right? Versus connected to your geography. And because increasingly what you're exposed to on your phone are US companies or foreign companies, people are much more amenable to investing in the companies that they know. Also, what's happening is because you have now AI/ML coming in, so we're about to launch an AI/ML investing product. So full disclosure, I have a bias here, right? We believe that you will be able to soon, as a retail investor, have access to recommendations that have 70, 80% accuracy, right? And so your ability to actually pick based on and these AI/ML models are typically going to be short models, right? Which is not predicting performance over 1 year, but predicting performance over 2 to 3 weeks, 1 week, 1 day. But that's actually, that's part of a virtuous investing cycle, because as an investor, 90% of investors like to see returns sooner rather than later. So if I ask you, if you could see 1% appreciation 1 week versus 1 month, you'd obviously choose 1 week, right? So AI/ML models interfacing with apps like ours are going to give you recommendations on a real-time basis that are 70 to 80% accurate directionally and give you the ability to make 0.5 to 3% on a daily, weekly basis. Why? Because you're ingesting massive amounts of data. You're replacing fundamental analysis with technical sentiment, news, insider trading, about 16 different sources of data. And you're going to actually have an investor revolution where you have as much information or more information than most traditional fund managers. So that's going to be something that is increasingly going to come in to the public domain, that's going to be available to you. And the proof of the pudding will be in the eating. There'll be many people making claims. Ultimately, there will be some models that work and some that don't. And investors will flock to the ones that do.
So as we know that US allows fractional buying of equity. So is it feasible for the retail investors sitting in India with a low ticket size to put in money in the US markets? And
what would your ideal ticket size be? How many rupees?
So currently I'm a student. I'm looking to put in 3-4 lakhs, 5 lakhs maybe.
Perfect. You download the app, you can send 1 rupee.
Do the transaction costs eat up the...
Yep, transaction costs, okay. Transaction cost will be a flat 1 rupee per transaction plus 0.05% of what you invest with no fixed transaction fees. So 1 rupee is not right, because what will you do sending 1 rupee?
Correct.
You're not going to make any, right? But let's say you want to invest 1,000 rupees. You can do it. Our lowest transactions on our platform lowest transactions are 49.50 rupees. So I don't know what people do sending that amount, right? I would say that's
Correct.
like pointless, but okay, that's there. Highest transactions are 60-70 lakhs, right? But if you're looking to send 4-5 lakhs, right, which is in a year, which
Correct.
is whatever, let's say 50,000 a month, absolutely, like your costs are going to be minimal. Check out the website, have a chat with me.
Yes.
Very affordable.
Thank you.
Subho, can you talk about the forex cost in this?
Yeah. So look, just to look at your question. So what used to be prohibitive used to be the forex cost, right? There used to be a 500 to 1,000 rupee fixed fee per transaction. Plus, there used to be handling fees. That would be another, 0.2, 0.3 basis points. Plus, there would be, a fee for the originating bank, and the receiving bank would charge you like another 0.5%. So, and then there's taxes. So if you did not I think the viable investment amount with all of these fees was somewhere around like 50-60,000 per transaction. Otherwise, it makes no sense. We have been working for almost 3 years to remove superfluous taxation, remove fixed fees, make sure the receiving bank doesn't charge you any money, make sure that the actual FX rate is proper, and enable us to have extremely good fractional algos so that you can buy up to 8 decimal places, right? You can literally buy 0.00000001, right? So Berkshire Hathaway is within your reach, right? If you want to.
All right, Subho, thank you so much. He'll be around as well in dinner, so you can ask him stuff offline. And finally, we have Raunak Onkar of PPFAS. All of you, I'm sure, know him already. So he's just going to answer your questions directly. There's no presentation. Have a seat, Raunak.
A couple of things that I've noticed with what these two presentations were and what Neil mentioned is most of it is geared towards a general purpose style of investing, where you will bring your own style and say, okay, you are going to invest in a particular way. I'll just give you another aspect of looking at it. So one person who asked a very perceptive question on governance risk while investing in global markets, something that we worry about a lot. So the reason why we worry about it is because we run an open-ended retail scheme where investors are free to take their money out tomorrow morning or keep it with us for as long as they want to invest with us. That open-ended nature does not allow us very easily to come out of investments if the investments are trapped in a country where we don't have trust with the governance of how the country treats outside investors. So we have filtered it deliberately at our end, making sure that we only invest in areas where the minority shareholder rights are there's a good track record of protecting them over a long period of time. So that eliminates a lot of emerging market countries for us, and we are okay with losing the opportunities in those markets. But nevertheless, there are, like Swanand said, there are some markets which seem emerging but actually are quite developed. So if you look at developed Asian countries, they have been around for a long time and they have a good pedigree of investing. But because there are so many multiple currencies involved, it also becomes tough to sometimes invest in those markets because you want to track so many currencies and so many markets. The another interesting way to invest in some of those stocks which are also developed in their own way is to buy the US listed stocks in those countries, or ADRs, the American Depository Receipts, if you are an individual investor. So that is what we have been doing as well. So although at PPFAS the fund is retail, we are focusing only on developed markets in the world, which is developed Europe, developed Asia and North America. But the companies listed in those countries also have ADRs listed in the US market. So you can maintain one currency exposure and probably also get exposed to the same profit pool that you want to invest in. That is the only different point I wanted to make, considering what the existing speakers have already spoken. Let's go into Q&A. I'm sure you have a lot of questions. I'm happy to answer anyone in all detail that you require.
You guys had invested in Suzuki in the past, so it's
Yes.
not just US market, you've also done other countries.
So Suzuki was a Japanese stock. We invested in the ADR. Then there was Nestle, which is a Swiss company. We invested in the ADR. Then British American Tobacco was a British company. We invested via ADR. Then there was Anheuser-Busch, which makes Budweiser beer, which is a Belgian Euro-listed company, which we invested through the ADR route. So you cannot restrict yourself to companies. Another interesting point I want to make over here is from a home country bias, it's also about a sector or opportunity bias that we have. Just because the company is listed in India and easy to buy and sell on the stock market doesn't mean it is the end all and be all of that particular sector. To case in point, if you are looking at auto industry, why restrict yourself to only investing in auto companies in India? So the auto companies in India might be trading at a very different valuation compared to global auto companies. You actually get a valuation differential, product differential, technology differential, and scope of profits that they earn from across the world when you go out of the country and invest in those sectors or companies outside of India. Why does it matter that IT services business is listed in India? Because most of the companies have operation base in India. If you look at Cognizant, if you look at IBM, if you look at Accenture, most of them have more employees probably in India in their global capability centers than they have in their home countries. The home countries might have consultants and high value salespeople who are operating from there, but bulk of the back-end work actually happens in countries like India. It's an established business model across several decades. So why restrict yourself to investing only in Indian listed IT services companies? Why not go out and invest in Accenture, Cognizant, some companies like that? So my point was, it actually helps you broaden your horizon for that sector and also makes you aware that the valuation that you see for a particular sector in your country may not be a representative valuation for all the investors globally. So if some sector is consistently overvalued compared to its peers globally, it better have a very good reason. Many times she doesn't have a good reason. For example, in consumer space, we have been laggards in investing in India for the past, in fact, since the inception of the scheme in 2013, we have not had significant exposure to Indian consumption stocks, but had a disproportionate exposure to global consumption stocks. Because even the parent companies of Indian subsidiaries are trading at a significantly lower multiple to earnings and cash flow than the local subsidiary, which has a limited business in India. So again, you are limiting yourself to a smaller set of products, smaller amount of cash flow, plus there is a royalty issue where the shareholders don't get the benefit of it, but the parent company gets a different benefit by owning the subsidiary in India. That you can bypass by just looking at valuations and opening up that opportunity for yourself. So these few points are a little bit different from what other speakers spoke. Yes, please.
Couple of questions. With the asset under management of FlexiCap reaching a huge sum, whether it is going to affect the performance, and the cash levels are still at around 24 or 25%. When are you going to deploy that? And
so I appreciate the question, but I want to be honest with the purpose of this event. We'll talk about it after this. We'll stick to the Q&A which are relevant to global investing for this official part of the event. Hope that's okay.
Hi Raunak. So I have a question, like how does Gift City impacts the investment? Like is it more focused towards for international investor investing in India, or there is some benefit for Indian residents investing outside?
So Gift City actually is a very interesting jurisdiction which allows both of these things. So far, most of the funds that are launched in Gift City have been inbound feeder funds, where most of the AMCs have put up their products so that so global investors can invest in India, the existing mutual fund schemes in India of these funds. The outbound piece is something which is evolving, and the regulations have also been evolving over the past couple of years. It has been more rapid, but actually positive developments have happened where there are different kinds of products you can launch. You can launch a retail fund which can invest globally. We can launch a passive fund which can invest into global passive mutual funds, or UCITS, which are again Irish based products, which are again, they work like mutual funds but they are actually based out of the jurisdiction of Ireland. Then there are other products which are PMS style products, where you can have a portfolio for a small set of investors and you can invest individual portfolios like how PMSs are built. You can have a outbound portfolio like that. And you can also have a AIF kind of product which is for a small set of investors. 1,000 investors can be placed in that particular AIF fund, and they can also invest abroad. So there are a variety of options now have recently opened up where we can see a lot of filing that is going to happen. In fact, PPFAS has also been making efforts to launch our own schemes. We are in the process of launching that scheme. We in fact have an office there. We have employees now over there, fund managers, principal officers are all now in Gift City. So very soon, like most other AMCs, we will also have a product which is outward facing. And then we can innovate. We can actually have a fully outbound, we can have a passive, we can have a semi-passive, we can do all sorts of innovation in that. So it's a good jurisdiction to have. But one thing to remember is it's only going to be part of a LRS scheme remittance. So if you are directly investing on your own, if you are traveling abroad, if you are sending money abroad for education purposes of your kids, then everything is counted in that. So you have to make sure you apportion it properly. It's under your LRS limits that is going to be used.
But with that, we have to bring this session to a close. Raunak, thank you so much.
Thank you, Neil. Thank you, everyone. Thank you so much.
Initially, when we began, I was worrying that Palki would stop people from coming. Now I'm thanking my stars that Palki happened, because we are chock full, and if more people had turned up, we'd have had to put them onto the stairs. So thank you so much for taking out the time and coming.